I'm the pension builder and I like to research companies which I believe are undervalued on the stock market. Today I'll let you know about my research on Leggett Platt. Leggett Platt is known for its high and stable dividend. But is there more value to find? We will find out very soon. First, let's have a look at the stock. Based on the 5-year figure, we can say the current price of $35 is a bit below the average. The current PE ratio is around 13, which is quite interesting as the earnings were not the highest due to the economic conditions these days. But that is something we will cover later on. If we look at the PE ratios of last 5 years, it can be noted that the market is valuing the stock lower since mid-2021. The graph below shows the inflation rate in the US for the last 5 years. As inflation becomes higher, the stock price falls more and the PE ratio becomes lower too. That is something we have only seen in 2020, with the pandemic going on. Now, let's zoom in a bit on the business. The company started with the main focus on its bedding products. This includes mattress springs and specialty foam. The company also designs and produces many components and products applicable to homes, offices and automobiles. Leggett Platt is divided into 3 segments, which are bedding products, specialized products, and furniture, flooring and textile products. As you can see, the company has a very differentiated product mix. Bedding products are the main focus for the company since day one, which can be seen too. The company is also active in many countries. However, the United States are the most important for its business. The company has many customers, which shows the quality of its products. Especially if you see names such as General Motors, Home Depot, Volkswagen and many more. The biggest segment is of course the bedding products segment. However, the company is constantly investing in the specialized products segment. On this sheet you can see a couple of the main products of Leggett Platt. Leggett Platt is constantly looking for improvements for its business. Even though the company is mostly known for its dividend, the company is also investing a lot in acquisitions, and also capital expenditures, which we will see later. The company is always looking for acquisitions. As you can see, next to dividend and capital expenditures, the biggest focus point is acquisitions. In 2019 the company completed the acquisition of ECS for $1.25 billion. With this acquisition of the specialty foam leader, Leggett Platt is able to provide customers the most advanced technology solutions in specialty foams. ECS had a revenue in 2018 of $611 million, right before the acquisition took place. With this acquisition, it will be possible to combine the comfort core products of Leggett Platt with the premium specialty foam of ECS. As we've seen in the acquisition strategy, Leggett Platt is always looking for such synergies. Looking at the most recent acquisitions, as the most recent quarter was the third, Leggett Platt acquired Pacoma Hydraulic Technology. This company manufactures hydraulic cylinders for heavy construction machinery. It can be used for excavators, elevators, but also metal shearing machines. This leading manufacturer had $65 million of revenue in 2021, and is purchased for $88 million. This company will add value to the specialized products segment. The revenue of the hydraulic cylinders group of Leggett Platt in 2021 was $94 million. This acquisition is typically bolt-on to existing business. Another interesting factor is the automotive group, which has the highest revenue from the specialized products segment. Leggett Platt is spending a lot of attention to that group, as there are many opportunities nowadays with the electric vehicle trend going on. As we saw before, Leggett Platt has many great customers. Think about Volkswagen or General Motors. The company is constantly looking for improvements. On the website, you can find their products. One of the latest innovations is the massage function in a car seat, called the advanced massage. Leggett Platt also focus on cable technologies and many other important components of a car. As you can see, the market we're talking about is worth $20 billion US. The company is convinced that the industry transforms to their space. The expected growth is above industry production growth. Leggett Platt can be considered as the strong leader in the targeted segments. The average age of vehicles is also extended, which is something the company can benefit from. Now let's move on to the financials to be able to value this stock. The company has a lot of debt. However, the company knows what it does with it. As we've seen before, a lot of money goes to acquisitions, capital expenditures and dividend. The debt is mostly long-term debt. As you can see, the weighted average maturity is 11.7 years. The company is always able to repay. No problems up until this day regarding debt. The revenue is growing slowly, as we look at the sales of the last 10 years. Pretty stable, based on these numbers. Free cash flow at the end of the third quarter is around $130 million, which looks okay. Leggett Platt lowered its guidance not long ago. So, also the expected free cash flow changed. It will be lower than the free cash flow of 2019, 2020, or 2016. If we take a look at the free cash flow history, we could say 2021 was terrible. However, it looks worse than it actually is. Operating cash flow was down a lot in 2021 due to significant additions to working capital. This had to be done to replenish the company's inventories. This is just a short-term happening, so nothing to worry about. The guidance of 2022 would tell that the company expects free cash flow of $280 to $340 million. This means that the free cash flow to market cap ratio is around 7.5%. Dividends are expected to be $230 million. The company does what it's known by, paying dividends. However, as an investor, I would hope to see more value getting created. To be more specific, the company could invest more in its automotive group as the automotive sector is growing at a high pace. If it's possible, Leggett Platt likes to invest significant amounts of money. However, as you can see in 2020, the company would cut investments to keep paying dividends. So, we could say that around 5% of value per year is guaranteed. On top of that, the yearly growth of the stock could be expected to be at least around 3%. Under normal circumstances, the targeted shareholder return would be a great yearly return. Let's value this stock to see if that's also my expected return. However, I would like to note that this stock is a good but slowly growing steady stock which pays dividend no matter what. Of course, that is what's happened until now. But, could we say it is a bargain at this moment? Let's find out. In my opinion, the dividend is a good measurement to value this stock. If we look at the previous 10 years, the average dividend growth was between 4 and 4.5%. Leggett Platt is constantly increasing its dividend, even in years like 2020 with a pandemic as we've all experienced. For scenario 1, we will look at the normal case under normal circumstances. Therefore, we will use 5% as the growth for the next 10 years. With a discount rate of 10% and the dividend of plus minus 5%, the intrinsic value would be $34. The current price is 10% below this intrinsic value, which shows a decent margin of safety. However, we also have a good case and a bad case. In a good case, let's say the acquisitions are going well, the automotive group is doing very well, and investments are paying off. Let's assume a growth rate of 6.5%, which is not something impossible if you look at 2016 or even 2017. In this case, the intrinsic value would be $39. Compared to the current stock price, that would mean a discount of around 25%. In the bad case, we can be conservative and assume 2.5% growth rate. To be conservative, we also have to take into account that the market will value the stock a bit lower compared to the other cases. This would lead to an intrinsic value of $25. However, this is pretty conservative as well as the normal case. On average, the intrinsic value is $33, which gives us a discount of 10%. So, very interesting to keep watching the stock and buy or buy more as it falls more. As we're coming to an end of this video, I will highlight the most important facts. There is a great business, which cares a lot about its investors, as we can see by their dividend strategy. It is interesting to see how the company is constantly looking for new opportunities, such as the automotive sector or stuff like hydraulic cylinders. Looking at the financials of the company, we can also say it looks okay. Steady but slow growth, so nothing shocking there. However, if there is one thing I'd worry about, it would be the debt of the company compared to its cash. On the other side, we've learned that most of the debt is maturing not soon. Based on our valuation, we could conclude that the stock is a bit undervalued at this point. However, remember that this valuation is based on my assumptions and estimates. To have a safe, guaranteed return of at least 5%, it could be an interesting choice. I will also keep watching it and hope to see it fall more to have the best opportunities. I want to thank you for watching this video. Please like and subscribe as I am aiming for a lot more videos.